Good evening, everyone. Thank you for joining this evening's Corporate Connect featuring Hrl Net Group. This webinar is organized by SIAS and supported by SGX. We'll kick off tonight's webinar with a presentation by Mr. Geoff Howie, Market Strategist from SGX, who will share with us on the recent market highlights. This session will be followed by a corporate presentation by Ms. Adeline Sim, Executive Director and Chief Corporate Officer at Hrl Net Group, and we'll end the webinar with a Q&A session. Hrl Net Group is one of Asia's leading recruitment and staffing firm, listed on the SGX main board in 2017 and established across 14 cities in Asia. The company's business are committed to collectively provide the best recruitment and staffing services and solutions. Without further ado, can I invite Mr. Geoff Howie on screen to take us through the market highlights. Over to you, Geoff.
Hey, thank you so much. I think you can see my slides, and I'll proceed. As always, the material that we are sharing tonight is educational and not advisory. So what I guess we want to do is just quick 15-minute mid-year wrap of the Singapore stock market, and for our first 6 months of this year, our Straits Times Index averaged, or not didn't average, it generated a 1.4% total return, ranking as the most defensive developed economy benchmark for that 6 months. The FTSE All World Index and FTSE Developed Index logged declines of, start my video. Oh, okay. I'll start my video. You can see, okay, I don't know what happened then, sorry. But I think everyone can see me now because I can see me. So I'll keep talking. So basically the SDI over the last 6 months generated 1.4% total return. That compared to the big benchmarks, the FTSE Developed Index, the FTSE All World Index, which both logged declines of 17% in total return. So that defensive marginal return of the STI, it was very much attributed to the decline of technology stocks across the world, which do command a much larger sector weight in the big global benchmarks. As shown in this bar chart, the STI is majority weighted to banks, real estate, and industrial goods and services. The STI's one technology stock, Venture Corporation, is included under the industrial goods and services categorization that FTSE and ICB employ. So amid these broad challenges of the past 3 years, this 1.4% gain of the STI brought the 3-year total return through to the end of June to 5%, which placed it almost at the center of the returns generated by the FTSE ASEAN All Share Index and the FTSE Asia Pacific Index. So the STI, with its, I guess, with the parent cascading geometrics of indices and this constituent overlap, is naturally more correlated with the FTSE ASEAN All Share Index than the broader APAC index, as we can see in this lower right chart. A significant regional reach of the STI constituents also does provide an economic foundation for this competitive performance of the STI. When you look at the prism of the STI constituent revenue, and you harmonize that revenue with the weight that each constituent has in the index, as much as 51% of the revenue associated with the STI in its weighted form is reported to countries outside of Singapore, which are naturally mostly in the Asia Pacific. So of the STI's 3 strongest performers this year, the last financial year for these 3 companies saw Yangtze Jiang Shipbuilding report 80% of its revenue to the PRC in Taiwan. Sembcorp Industries reported 60% of its revenue to Singapore and 20% of its revenue to India. And also Jardine Cycle and Carriage reported 90% of its revenue to Indonesia. And HRnet Group, who are with us tonight, also operate in 14 Asian markets. So there's a great deal of diversity in the STI. As a product, the 2 STI ETFs, the Spider STI ETF and the Nikko AM Singapore STI ETF, they currently represent about 18% of the combined 12 billion Sing dollars of assets under management in the entire suite of ETFs that we list on SGX. They have actually seen combined outflows of $150 million Sing over the past 18 months. But that's after they logged up a record $950 million of inflows during 2020. And this year, the Spider Sdi ETF celebrated its 20-year anniversary listing on SGX and has paid investors 6.1% annualized total returns since it listed in April of 2002. So looking at another area of diversity of our stock market, it's across the different sectors and industries. On a day-to-day basis, there's 1.3 billion Sing dollars of stocks trading hands in Singapore. And in addition to these diverse regional revenues that we looked at in that last slide, there is also significant diversity beyond the SDI across various sectors and subsectors. So just as, for instance, just as services are a key cornerstone of the Singapore economy, services are well represented through the various sectors that make up the SDI. They find relevance in banks, consumer subsectors, broader financial services, healthcare services. There's some industrial subsectors that include professional services. That was what we hear a little bit more about tonight. There's real estate, technology, and telecommunications. So services, as we know, make up around 70% of Singapore's GDP, and services producing industries, as we know, expanded, I think it was 4.2% year on year in the first quarter of this year. That follows 4.4% growth in 2021. And that was led by, in the first quarter, real estate, ICT, and professional services segments. Manufacturing, which makes up 20% of Singapore's GDP, also threads through a number of subsectors, and we discussed that last week. Oh, not last week, 2 weeks ago. As you can see, though, in these comparative donut charts, the three banks, DBS, OCBC, and UOB, represent 1/5 of the total market cap of Singapore's stock market, but more than 1/4 of the day-to-day turnover of the Singapore stock market. And since Singapore has emerged as a global REIT hub a few years back, we have seen the REIT sector contribute more to the day-to-day turnover tally, much more than they do to the overall pie of market capitalization. And importantly too, there's a lot of thematic bandwidth, because if you look at the strong interest in energy stocks across the world this year, with much outperformance in all the upstream plays across the world, we saw energy stocks here in Singapore make up 2% of the day-to-day turnover of the Singapore stock market, while at the same time only contributing 0.5%, 0.5% to Singapore's overall market cap. And after, as we said, as SDI is largely made up of banks, as we've said in many of these presentations, and after performing comparatively defensively in the earlier part of the year, banks did underperform globally in June. And as the mega theme of growth really took center stage, we saw the bank sector sell off somewhat and actually underperform in the month of June. So what we saw in June, obviously, World Bank downgraded its 2022 growth outlook down to 2.9%. Previously in Jan, they thought growth would be 4.1%, but that was a significant downgrade for their outlook for 2022 to 2.9%. And markets were pricing in further potential impacts of that slower growth might have on bank loan books, which obviously help determine net interest income along with net interest margins, which net interest margins, while the long end of the yield curve is greater, the SORA short-term gains have been very strong as well. So you've seen that the sector basically price in the impact that the slower growth may have on non-interest income activities as well, like wealth management, in addition to the loan books across the world. So the first half results for DBS, OCBC, and UOB, I think, are expected to be released between 29 in July and 4th of August. And that will provide us with a lot more insight on the current operating performances, obviously liquidity and outlooks. Telcos and industrials did lead the net institutional flows here in Singapore for the first half. And those sectors also generated comparatively defensive returns compared to the three sectors that saw the most net institutional outflow over the first half of the year, to the right side of the bar chart. And I want to point out that looking not so much from a sector perspective, but that familiar microeconomic thematic that we've talked about, we should note that 5 of the stocks that booked among the highest net fund inflows in the first half of this year have been among the group of stocks that have also been pursuing strategic initiatives to restructure or pivot their business activities to new business activities to add shareholder value. Singtel, it's transforming the NCS business to a digital champion. We know ST Engineering is pursuing a new structure to strengthen its global growth focus, consumer focus, deepen its engineering and technology core. And management has also flagged alignment with digitalization with cloud, AI, analytics, and cyber business expected to triple by 2026. Keppel Corp is obviously pursuing its transformation to that integrated sustainable urbanization solutions provider under Vision 2030. You've got Sembcorp Industries also pressing ahead with the strategic transformation of its portfolio from brown to green energy. And then you've got CapitaLand also completing its transformation to a real estate manager last year. And those 5 stocks within the STI actually booked a total of $1.1 billion of net institutional inflows for the first 6 months of this year, while averaging 22% total returns. So as we said, that focus on adding shareholder value and restructuring or pivoting to new businesses has seen a little cluster of stocks within the STI basically outpace the STI just for the last 6 months only. We should mention too that with the reopening momentum, City Developments and CapitaLand Integrated Commercial Trust have also ranked among the stocks that have drawn the most net fund inflows. In the meantime, retail investors have been net buyers of technology, REITs, and banks since the local banks posted those highs in mid-February. In terms of that technology sector that we touched on before, it was the worst performing sector of the global stock market in the first half of this year, as we said. And in Singapore, the tech sector also booked the highest net institutional outflows proportionate to market cap, as you can see, by quite some margin. Combined, the 5 most traded tech stocks listed on SGX, which are Venture Corporation, AEM Holdings, UMS Holdings, Franken Group, Nanofilms Technologies International, those 5 stocks averaged 27% declines in the first half of this year. Digital transformation, it's clearly a longer term structural demand driver of the sector, but consumer confidence, operating factors such as inventories, energy, supply chain pressures, and other input costs, which of course include rising interest rates, will continue to be watched in this coming half of the year, this latter half of the year, in addition to valuations, of course, which are now some 30% off their 2021 levels. On the other side, on the top of that chart there, for the first half of this year, we saw utilities and telecommunications book the highest net institutional inflows proportionate to the sector market cap. So Sembcorp Industries and Keppel Infrastructure Trust, they generated respective total returns of 44% and 8% in the first half of this year, while Singtel generated a 9% total return and Netlink NBN Trust was unchanged. So I guess local and regional reopening progress also saw real estate, excluding the REITs, rank among the sectors with the highest net institutional outflows proportionate to market cap. Now, I'm making this proportionate to market cap because as we saw in that donut chart, banks make up 1/5 of the total market cap in our Singapore stock market. That's 3 stocks alone. So obviously the size of those stocks command much higher flows, net institutional inflows and outflows. So to get a clearer picture, what I'm doing is taking those flows over the period and dividing it by the end of the first half market capitalization. So everything's put proportionate to the size. The flows are basically charted here in proportionate to the value that this sector has in the market. And like we said, real estate, interesting that real estate, excluding REITs, did rank among those sectors with the highest net institutional inflows proportionate to market capitalization, inflows proportionate to market capitalization. So Hong Kong Land Holdings, City Developments, UOL Group, Yan Lord Land Group, Yoma Strategic Holdings, and Hong Fook Corporation. Those stocks averaged 11% total returns over the first half of this year. But looking to the second half of this year, obviously the ongoing Ukraine crisis, the new global supply chain developments, which have seen container costs and bulk costs on a gradual decline since September and October of last year. You also have the continued impact of COVID and the BA4 and the BA5 and the resurgence in these strains, that every time we have a resurgence in the strains, cases go up, which can affect business activity, albeit I think as HRnetGroup, I think as Peter Sim wrote in the annual report, which I did read about 5-6 weeks ago, 2021 was the year that we did psychologically defeat COVID-19, but we still are subject to these constraints here and there, and potential, as we've seen in China and Hong Kong, lockdowns and so forth. And the good news is, of course, that the severity hasn't gone up, or albeit transmissibility, how transmissible the virus has actually gone up. The transmissibility has gone up while the severity hasn't gone down, but nonetheless it is on the radar of just about every company, particularly in those services and consumer services businesses. I should also mention the interest rates are the clear driver as well. Obviously, we are looking very closely at the pace of the two mega drivers, that is growth, looking for the pace of deceleration of growth and the pace and the acceleration of inflation. Those two key macro drivers are really setting the stage for the second half of this year. And as the Fed chair noted at the last FOMC press conference, the neutral rate that they are targeting is not so much a set level, but it's more a judgment call. And given that the Fed do like to give the market as much transparency in their decision-making process as possible, we can expect markets to move around a little bit and to keep swinging as we do try to take cues from the Fed officials when they do speak, albeit there will be a blackout period 2 weeks before the next Fed Reserve meeting. But nonetheless, markets will be looking to policymakers for their judgment calls very much in these first few weeks of this second half of this year. But as we said, for the first half of this year, the STI did generate a 1.4% total return. That makes it the most defensive developed economy benchmark for that 6 months. HRnetGroup also did achieve a 1.4% total return in the first half of this year, but that was after HRnetGroup posted a comparatively strong 2021 with a 53% total return. And I think it was the same year last year, 2021, that the company did celebrate 30 years of operations. So good time for me to stop talking and start listening. And I think Adeline, if you want to come on now, Adeline is the Exec Director and the Chief Corporate Officer of HRnetGroup. And I'll switch to listening mode now. Thank you.
Thanks, Geoff. Over to you, Adeline.
Thank you. Thanks, Geoff. I found that really educational and very interesting. Particularly the point about how, for the well-performing SGX companies, a large part of the contribution actually comes from outside Singapore, and that's definitely the case with us. So we are 44% outside Singapore, and that's Asia ex Singapore. And yeah, I think there's something to be said about Singapore being a hub. So maybe I can first start by wishing everyone a very good evening. And I'm very grateful to get to speak to people who are interested in HRNet in our company. I do hope you managed to grab an early dinner. But if you haven't, then I hope to make your next, 40 minutes or so worth your while. I don't have my CFO with me tonight, neither are there any analysts here, so I do intend to take a very operational approach to the presentation and really tell you about what we do and what we're doing right now. So if there are any questions that you have, please do put it into the chat and I'll try to answer them, or I'll try to get answers to you if it requires input from anybody else. So I do see some familiar names amongst the attendees tonight. So please bear with me if I go into a little bit of detail as to what exactly HRNet does. Right, so basically, if you drive a hybrid car, you will appreciate the fact that we are dual-engined or hybrid. There are two main engines to our growth, two main things that we do. Number one, professional recruitment, which is really the headhunting as you know it. So, you always find people who will tell you they were headhunted, and yes, that will be by people like us, where we actually find out from clients what roles they need to fill, and then we go out there and we hunt and we poach for the talent to put in our clients. And sometimes I get questions even from family members, oh, why can't you help so and so find a job? And this is where I really must explain that it's very different from the impression of what we do. Really, for us, what we do is to look for what the client needs, right? Compare it to the talent landscape. We're actually very exhaustive about comparatives within a landscape, and then we advise clients on the best talent to take for them. So that's why we don't so much represent individuals per se. We actually go out and represent corporates to hunt for the best talent for them. So that's half our business, right? Professional recruitment, headhunting, and this is where we are in 14 cities, and it's the core of the business that was started 30 years ago. We actually turned 30 on the 28th of March this year. So that's our professional recruitment business. The second thing that we do, which has really been steadily building up over time, and you can think about it as our electric engine, something which is really recurring and which works out really well, is our flexible staffing business. So for this part of it, we actually employ contractors directly and then deploy them out to clients. And on any given day, you can have 15,000 people who are out working with our clients. And we had a question come in before the session as to whether or not we hold inventory, as in whether we employ people and then after that have utilization issues. And the answer is no. In the 5 cities where we offer staffing services, so primarily Singapore, KL, Jakarta, Hong Kong, Shanghai, and Taipei, 6 cities actually. In all these 6 cities, we employ the contractors on a back-to-back basis. So we only employ them when there's an active assignment on with our clients. So in this way, we do not have utilization worries or concerns, and that there's no issue with basically unutilized talent. So with the contractors, I think what happens is that you will find, particularly in very volatile times like these, that clients are very much in favor of our flexible staffing services. To give you an idea, who are the type of contractors who are deployed out? You have people in MOE kindergartens that basically are our contractors. You have people who are nurses in our hospitals. We had vaccinators when those centers were all open. And right at the start of COVID, literally overnight, we had to put in 300 temperature scanners into Changi Airport. And this was an overnight deal, literally. In between, as the retail stores opened and closed, then we had basically the retailers telling us, okay, I want 150 people tomorrow. And then similarly, whenever we're in tightened situations, they'll say, okay, can you please let these people go? So our flexible staffing services are actually something which are gaining popularity, and I'll go into a little bit more detail further on. But maybe I can start I realize I still am on the cover slide. I can start with a little bit of our growth story just to give you some backdrop to where we are today. So this slide shows you our footprint, our 40 offices across 14 growth cities. And really you'll find that, basically in any city where there's urgent need for talent, we'll be there, because we literally follow our clients. And every time when we wanted to start a new office, there are only two conditions. Number one, there are clients who want us there, and many times, we get requests from a regional office, for example, Shanghai or Hong Kong or Singapore, and say, can you please move into a new city with us? And our next criteria would then be to go back to our existing leaders and say, who is willing to move? And many times there will be people who are excited. So for example, with the start of the Shanghai office, we had people moving from Taipei, Singapore and Hong Kong because they saw the promise of Shanghai. And then this time around as well, when we were moving and starting up in Shenzhen, it was a team from Guangzhou that said, a team from Guangzhou and two more from Shanghai, they said they wanted to go in. So that's pretty much how we normally start. So the next slide, you will see actually the different business units that were started in each year, and it's actually pretty much clear how it's a very steady progress. I think for the first 25 years or so, we grew completely organically. So literally, each unit was set up on our own. And then in 2017, we had a big change when we went public. So that was when we actually kind of started looking for M&A targets as well, because we then had acquisition currency in the form of our shares, and we actually did some really, really nice deals. So I think the first one that came in was HRnet Rimbun. So this was our offices in Jakarta. We had not been in Jakarta for a long time, since '97 during the riots, and so this was a return to Jakarta. And then this was followed very quickly by Reforce in China, and then Centrepoint personnel in Hong Kong. So the interesting thing I think about all these three acquisitions is that we've seen a CAGR of 47% in net profits from these three entities, and an ROI of 41%. So I think these were really very, very good acquisitions for us, and we continue to be on the lookout today. Particularly in the current environment, there are many companies which are up for sale and which we're constantly studying and analyzing to see whether we want to basically engage with them. So what you see is that we had all these organic units which were set up on our own, and then in more recent times the acquisitions, and thereafter, so this is where it gets even more interesting, when after working for some time with the acquired companies, we realized that the working relationships were so good, we could go into new joint ventures with them, and that's when Recruit First Jakarta came about in 2020 in the midst of the pandemic. We started our staffing services there, and we're really very, very pleased when within 2 quarters they were already profitable. And then this year, of course, we have Reforce in Chengdu as well, and we have another brand that's coming up with Reforce. So I think it really shows that with the acquisition that we made, we built very strong ties with our partners, and then we go on to build even better things with them. Yeah. Okay, so I think we can next go on to just give you an idea of our growth and profitability since inception. You will see, I think there's only 1 year, it's 1997, where I think we lost $20,000, but apart from that, this company has always been profitable, and it's something that it's very important to us. So we've never, and if you talk to any one of the 1,000 of us in the company, nobody ever says we will grow at the expense of profits. That's not the game we play. There are quite a number of clients where we chose to walk away from because we said it's not worth our time. So we're not after profit share. We do want to build a very long-term, a very profitable business, and it shows, right, as you can see from here. The other phenomena which you might find interesting really is the fact that after each crisis, we actually end up doing much better. And we think that's because, with each crisis, the team grows closer together, stronger together, leaner, and with a stronger sense of where we want to head to. right? So it's very obvious after every crisis, you see that, you know, it spikes up, and well, we're pretty happy that that seems to be the case for COVID as well. The next slide then goes into the two business segments that I was talking about just now. You'll see that it's pretty evenly spread now. You have, you know, in terms of revenue, because we actually carry the contractor payroll cost in there. So in terms of revenue, flexible staffing then contributes 83%, and professional recruitment 16%. But once it comes down to GP, then you see that, you know, flexible staffing is at 45% and professional recruitment is at 54%. So that's really because the payroll cost of the contractors goes into the revenue as well. Maybe if I can just show you very quickly the next slide, this is actually talking about how we fully expect, you know, the number of contractors to grow. So this is just the Singapore market where there's some more recent statistics, and you can see the number of fixed-term contract employees has been going up quite clearly. Previously, maybe, you know, 15, 20 years ago, there could have been some stigma with being a contract staff. There's this sense of, well, you know, it's much better to be in a perm job, but that's no longer the case. So I think pretty much, you know, this idea of being a contract employee is very well accepted now amongst fresh grads and even those with, you know, 5 or so years of experience. And with employers, then they fully appreciate the fact that you know, having flexible staffing and contract staff gives them the ability to respond to the market much better. Yeah. Okay. So next, then we see the geographic mix, and flexible staffing in Singapore is a strong product for us. I think up to 20% of each A-level cohort actually is our temp at one time or another. Yes, you know, this is quite a funny story. So there was once when I was talking to an analyst who was covering us for the first time, and after a while I realized that he seemed very familiar with what I was talking about. And I said, oh, you know, you seem to know us well. And he said, yes, I was a Recruit Express temp. And when I went to interview for my job, I actually used HRNet as my case study. So I'm like, oh, that's really cool. And perhaps even more encouraging, there's another analyst, and she then decided to leave the bank after a while. And after she left the bank, she actually called us to say, you know, now that I'm able to actually decide to invest personally in HRNet. And we're like, oh, that's really, really nice. As in, it's very reassuring when people who, you know, have experienced our services, whether it's clients or contractors or candidates, then decide to buy our shares because they totally buy our story, right? So, yeah. So that's the regional mix for you. When it comes down to GP, you know, it's what Geoff mentioned. We are only 56% Singapore. Pretty much investing in us is investing in the Asian talent market. You know, that's very much the case. Yeah. Okay. Let me talk about something unique to us. Tomorrow morning, actually, I'm going to be talking to 40 MDs from Thailand, and we're going to be talking about this because it's really something unique to HRNet. When we were working on listing the company in 2016 and 2017, everyone told us that we would have to roll up the minority holdings in our subsidiaries into the listco, simply because that was how it was done. And we didn't like that, because for HRNet, there have been two things that have always stood out very clearly, which is that our key leaders always personally invest in the subsidiaries that they run, and then the expectation is that the majority of their income should come through dividends and not through salary. So this was basically the remuneration model that had been in place, you know, since the start of the company, and we didn't really like the idea of changing it just because we were going to go public. So we're really lucky, I think, when we were doing some research, and then we came across a company called Hong Kong Broadband. They had listed 2 years before us in Hong Kong, and they adopted a similar approach. So with their help, we actually took all their papers and, you know, what had been approved by HKEX, then we went with that to SGX and said, can you please consider letting us, have a co-ownership model as well? And basically, we were the very first ones here. There's nobody else who has a similar ownership structure, where on the operating level, you'll find that, typically most of our subsidiaries, between 10 to 15% or so, are owned by the operators. And it makes a huge difference, because you'll find that then they are very, very much aligned with the shareholders of the listco, and nobody's riding on each other, right? It's really each unit that you run, you are going to make the dividends from that. And you'll find that because of that, our people think very differently. When we used to travel a lot, and you'll find everyone sharing rooms, flying economy, flying budget, and basically being very, very aware of the bottom line, because they are shareholders of the company, right? So it's a totally different mindset, I think, and we are really, really glad that we have been able to keep this structure, and not only to keep it, but to grow it. So when we listed, I think we had 22 of these co-owners, and over time now we have 37. So you'll find that once a business unit is doing well, people are really, really happy to have the opportunity of being a co-owner. And when earlier this year, this was announced on SGX Net, we extended the invitation to some of the co-owners you see here today, Miranda in Taipei, and Karen in Hong Kong, Hermosa in Shanghai. They were all really happy to come up with cash. So they came out with hundreds of thousands of dollars to invest in the company, and yet they're so happy to do so, because there's really the sense of pride, and also the sense of happiness that they are now co-owners of the units that they run. And best of all, I think that gives us really longevity, because when you have invested $300,000 in the unit that you run, you're unlikely to throw in the towel too quickly. You really think on a much longer term, and that's what you find in our co-owners. Yeah. So in 2021, I think just now Geoff did allude to it as well. We did give ROE of 18%, and our dividend yield to our shareholders was 5%. And going forward, sorry, Faz, this will be the next slide. You'll find that the one on shareholder returns. You'll find that we do intend to stick by our practice of having a dividend payout of at least 50% of net profits after adjusting for one-offs or exceptional items. And in fact, in 2021, we declared 57%. So this is a policy that, a practice that we fully intend to follow, and we've done so for the last 5 years. 3 weeks ago, we announced a share buyback program, and the intent really is to buy back, shares whenever we have the view that they're undervalued, and it can then be used as acquisition currency for buying new companies, as well as in payments for co-owners and employee share plans. So I did have a question earlier about how this share buyback mandate will affect our plans for more acquisitions, and the reality is that then, many times we do ask targets to say that we will want to pay some part of the consideration in shares, because we want them to be aligned on every level. So, for them to own part of the company at the operating level and also at the listco level. So that's something that we fully intend to continue doing. Yes. Yep. And I think then it kind of brings us to the last slide, which is the fundamentals about the company. Last year, 2021, was the first time we crossed the 70 million mark in terms of profits. I must say it came as a surprise. When the year started, there's so much uncertainty, but we were lucky. I think our people kind of respond very quickly, and the moment whenever there were the new trends, whether it was first it was safe distancing, and then you have vaccinations, and then after you move on to nurses. Every time when there was very hot demand, you can be sure that our guys were there, right? So the profits were really at a very good level. I did get a question whether or not we expect 2022 to be similar, and I would say that at this point, for our operating underlying profits and performance it does look like, we should have a pretty good year as well. So barring anything too bad happening in the second half of the year, I think, it's 2022 will be a good year, especially on an operating level. We do have basically, yes, the idea of continuing to grow through co-ownership. So you will see as we have more subsidiaries coming up, we will continue with the co-ownership model, and we fully intend to kind of spread out the network, especially in the north. So that's something I think which has been a constant refrain, and you will see the last 3 cities that we've entered are all in China, and that's because really there's a lot of demand there, particularly after this round of lockdowns in Shanghai. I think it was very timely that we went to Chengdu. Even with a recent survey we did with fresh grads in Shanghai, I think the 2 cities after that would be Chengdu and Suzhou that they are interested to look at, especially after being locked down for so long. But I think generally, our Shanghai offices are all back fully, 100%, back in the office, and things are pretty much back to normal, which was of great relief to many of us. There was a point where we actually had to send food boxes out because we had calls for help from our colleagues there to say they could not even get access to food. But just as quickly now, everybody's back in the office and really very much running ahead. So we do think that Shanghai should be able to make a quick recovery. That's what we're really expecting. Just to jump to a couple more questions that we had before, which I've not answered yet. I think there's a question about whether we have outstanding legal liabilities, and the answer is that there's nothing material at all. At any one point in time, we'll always have some debt collection work going on, but no, there's nothing material at all going on, so that's fine. What's our innovative plan in the next 1 to 3 years? And I think this is where, when I was just reflecting on how we have changed since we listed 5 years ago. Basically, it used to be the fact that when we first went out to meet investors, we'll say, we're an offline company. We're not competing with LinkedIn or any of the HR apps because we are professional services and we're offline. But 5 years later now, I would say that technology is very much baked into our system. So whether using our app for our contractors to selfie in and out of work, and for some of them there's geofencing so that the client knows exactly where they are, for them to apply for OT on the app as well, and for the clients to give immediate approval. Apply for leave by the hour in the case of Taiwan, where that's a feature which is common. So many things are now being driven by our technology, which leads me to say, when I wouldn't say anymore that we're an offline company at all. It's really, really, very much a case where technology is baked into our system, and a lot of it is being run through our systems. So even our letter of appointments for our contractors. So you can imagine, with I think any given year with close to 50,000 people who sign employment contracts with us, and now all that is being driven out through our platform. So it's generated and sent out to their mobiles, and then e-signatures are then sent back in. And in the case of Singapore, you can use My Info to basically fill out your data. And when we had Trace Together, you actually use Trace Together through our app as well. So yeah, I would say that in terms of plans for the future, it's very much to continue building up our platform and our technology to kind of to drive the business to a whole different level. Yeah, that's what I would say. Yes. Sorry, Lina, I just saw your message.
Hey, thanks, Adeline, for the sharing. Now, we've come to the Q&A session. Before I invite our moderator on screen, do note if you have any questions, you may type in the Q&A function below. For audience watching from Facebook, click on the link in the description to join the webinar. Okay, we'll try to answer as many questions as possible. Now welcome Ben, our Head of Research and Investor Education, to moderate the session. Over to you, Ben.
Thank you very much, Michelle. I think, Adeline, thank you very much for your presentation, and you have done quite a fair bit of my job because I was supposed to ask you the questions. But I guess that is part of the ethos of Hrl Net Group, right? Kind of a DIY, gung ho, go and chung first kind of mantra. I mean, listening from the presentation that you gave, and again, very appreciative because this is one of those, I suppose, rare type of presentations where a jaded analyst like myself, I find my jaw on the floor, because somewhere you mentioned that you made a loss of $20,000 in the year 1997. That's less than what people lose in one single Bitcoin in the last couple of months, and that's 1/5 of a price of a COE nowadays. So that, wow, right? 1997, that wasn't a great time. And that's a good segue into some of the questions they already have. So the first one I was thinking of asking you was about the growth plan. So you mentioned things are coming back to normal, especially in China locations, Shanghai, and clients are coming back, and then you need to match the clients' needs versus the candidates that you already have on hand, so on and so forth. And again, referencing the chart that you showed, always increasing revenue as well as profit. So how do you see your profits in the next couple of years, given a lot of noise about some upcoming world-ending recession / zombie apocalypse?
Yes, I mean, I can see one of the questions is whether or not we are recession proof. And unfortunately, I think I must say no. I wouldn't claim to be recession proof. We have definitely, even in the chart, you see that there are definitely moments where it strikes us as well. When COVID first started, it was, I must admit, terrifying. Because you just find that all the clients for the permanent recruitment business just saying we're freezing hiring, we're not hiring, full stop. Right? So no, we are not recession proof, but we do kind of try to pivot as quickly as we can to growth areas. So to give you a sense, it used to be that if you are the client holder for, let's just say, Singtel or something like that, you kind of have made it. You don't really have to do very much, and every quarter you just know that the contractor margins come in. That's no longer the case. I think even our client holders now all have to constantly be on the lookout for new cheese, and that's the reality, right? We had the client holders who helped Uber, and in its heyday we had 500 contractors there. All was rosy, and then literally it was a Friday, and I remember it very clearly because the phone call came in at 9:30, and they say please get rid of everyone by 5:30. Right, so you can imagine that the client holder's heart dropped. So no, not recession proof, but I would say we are always very nimble, very agile, and moving as quickly as we can. And I think the way we are structured allows us to behave in that way, right? So just now I talked about the co-ownership. So a lot of our decisions we try as far as possible to localize. And a classic example, for example, right now, we have 50% of our consultants focus on engineering, tech, healthcare, and semicon. So even though we have so many specializations, but all the different offices kind of just gravitated towards these 4 areas in the course of the past 2 years, because this is where you see growth, right? So yeah.
Okay. Thank you very much for that. And I guess that also speaks to the senior managers being stakeholders themselves, having some skin in the game. And from a academic perspective, this is what you call the principal agent problem. So it doesn't sound like you guys have got too much of that. I don't know, because a long time ago when I was at a bank, no banker would be caught dead flying economy. It's either business or first class, as they say in French, wait long. So obviously that's a totally different model as well as structure there. So pivoting to or rather tagging on to what you mentioned just now. So you've got this very innovative I guess co-ownership kind of structure, and then you're talking about your app, your technology platform. Would you be able to provide some color as to what other types of innovative ideas or or products that you have that help to distinguish Hrl Net Group from its competitors?
Sure. So I think, sometimes we get the question, how hard is it to be a headhunter? You just need a phone or you need to play a round of golf, right? So I think this is where, when we talk about using platforms now, so when we are servicing regional clients, for example, we realize that we want the experience for the client to be consistent across all 14 cities, right? So right now, whenever we work on a new role, we will generate a position profile report, which is the same across all 14 cities. So you'll have the same client logo, it will have the same format and same points that are discussed, and you won't be able to tell whether it's generated in KL or in Hong Kong or in Shanghai. It's we have standardized it across the way. Same with our candidate profile reports. So we kind of said, actually, the client's not interested to see the normal CV. Everybody knows how to dress themselves up by now. So what actually do they want to see? So our first page really goes into great detail as to the talent landscape. Where does this person stand compared to all the other talents in this area that you are looking at for this budget, right? For example. So I would say that that's where you find that clients who work with us, it's a totally different experience from working with some other firms.
Okay. Should I send you my CV for a free assessment? No, really. Okay. My boss might be dialing in. Okay. Now a couple of other questions here. So I think maybe to dive into some of the financials, the technical side of things. So there's a question here about paying contract workers first before collecting from his customers. So I guess the question here is surrounding the cash flow as well as the AR turnover, so on and so forth, and whether or not there are credit risks and clients not paying up.
Yeah. So I would also invite you to think about it another way. It is a huge opportunity. Last year, in the first half of the year, we had to pump literally $40 million into the flexible staffing product, simply because there was such an increase in volume. We used to do about, at that time, maybe 11 to 12,000 a day, and went up to 14 to 15,000, right? So there's 40 million that needed to go in the system, and we knew which of our competitors couldn't fight at all. They couldn't go in. They couldn't even bid because of the cash flow requirements. So I would actually view it, or I view it as an opportunity. It's something real. So when you find the ARs going up, it's not a bad thing, so long the business volume and the profits are going up as well. Having said that, yes, there is risk, of course, because typically we pay out to the contractors first. We're legally obliged to, right, as in under the Employment Act, and then we invoice the client. So there's at least a 60 to 70 day lag time. And we are very conscious about it, particularly after being bitten by certain ride-sharing apps previously, bike-sharing apps. So because of that, I think, when we onboard a client as well, we are very careful, and we basically, finance will have this whole KYC thing, which they will go through. We generally have thresholds of how much credit we're happy to extend to clients. In certain cases, we'll just say, no, please give us an upfront float when we're not prepared to go beyond a certain amount. And there are constant alerts. Basically, every Friday, I have this whole bunch of alerts as to which clients above, certain levels and whether we're comfortable with that. So normally, if I see the usual suspects, if I see Singtel, I'm like, yeah, that's fine. But if I start seeing certain names that I'm not comfortable with, then straight away we'll jump in and go to the client holder and say, please do something about it. The fortunate thing is that we are structured such that we're on a profit sharing system, right? And a very clear rule is that if you do not collect your AR by the end of the following quarter, so let's say it's a sale that happens in Q3, right? If by the end of December you don't collect on your sale, we won't pay you on it. So the consultant will get nothing for the sale. So you can be sure that they are very interested, number one, in working with clients who can pay, and number two, in collecting the AR, because otherwise they've done work for nothing, right? So yeah, I think you'll find that receivables are not, touch wood, not too much an issue for us because of all these systems that we're putting in place. Yeah.
Okay, that's very reassuring to retail investors actually. So there is a deliberate decision and deliberate strategy in trying to choose the kind of the safest accounts,
Yes.
vis-a-vis the revenue that it might bring in, so on and so forth. Okay, I mean that's great actually. Um, we got another question here. Again, getting down to the specifics. The company has a large cash balance of $330 million as of end of fiscal year 2021. So the question here is about the capital allocation priorities, whether it's going to be plowed back in for organic growth, or is it going to be used for share buyback, or maybe some kind of acquisition strategy?
So all of the above. I think, we do have the track record. I mean, it's like I mentioned, right? The staffing business is actually very capital intensive, especially when we want to grow it. That's number one. Number two, even growing organically with the professional recruitment business does require cash. Typically, with every new setup, we would put in at least $1 million, for professional recruitment. So we have 40 of such business units. It gives you an idea. Then yes, we are doing share buybacks right now. And we are looking at M&A as well, so it's really all of the above.
Okay. All right. So all the above. All right, great. So a different question here. How does solutions from HRL Net Group compare to purely online providers such as LinkedIn?
So I would say that, LinkedIn, it's a different creature from, let's say, a job portal. LinkedIn doesn't purport to basically do the actual matching. They're just saying that we'll show you who is available in this space, right? I mean, that's how they position themselves. And then you have the job portals who basically say that, oh, these are all the ads and you have everybody applying to it. If you, I'm sure many of you on tonight's call would have tried hiring for yourselves, and you'll find that you get all kinds of responses. I used to be from a law firm, and then when one of my friends went out to start his own firm, and then he called me and he was like, you know what, I put out an ad yesterday, I have 50 responses and 49 are foreigners. He's like, what am I supposed to do? I'm like, you could have asked me. Anyway, the fact is that if it is every hiring manager's nightmare to have to just put out an ad, whether on a job portal or previously used to be the classifieds, right? Because you have to sift through a lot. It takes many hours to actually go and do it. Whereas if you work with a recruiter, many times the client's expectations is that we shortlist for them. At most, we give them 5 people to meet, and they will pick the person from there. So please don't waste our time, right? That's our client's expectations. So I would say that yeah, we perhaps you could see that we're further up the value chain. We use all the platforms as well as part of our mapping to find out which are the candidates we want to profile and shortlist to our clients. And then thereafter, it's our very in-depth knowledge of clients to allow us to identify the best person for them. So yeah.
Okay, so it sounds like this kind of platforms like LinkedIn are not really direct competitors, and in fact, you actually use them as part of your search process
Yeah,
as
it's
well.
part of our work. It's like way up in the funnel is basically
Oh,
yeah.
okay. So we're not enemies. We're actually using you guys. Okay, that sounds good. All right, and following on the question about competitors. So we've got a couple of questions here about who are the competitors for HRL Net Group, as well as uh, how does HRL Net Group compare in size as well as reach vis-a-vis its competitors.
I think if you're talking about size, then in Asia, if you leave aside, the giants in Japan, the world's largest is Recruit, right, in Japan. If you leave aside the Japanese competitors, we would be, at the time of the listing, we're definitely the largest one based in Asia. And I would think it's still similar because manpower is still smaller. And well, there are many players, I would say, but there are not many that are that large. And we do look up to our Japanese peers. So, you'll find that there are many there that do really well in Japan. And, even this thing about keeping cash is something that we have noticed and learned from there as well. Yeah.
Yeah, certainly the way the Japanese run their businesses are, in a sense, quite conservative.
Yeah.
right? Harvard MBA will never be caught with so much cash. It's like it's a drag. But anyway, cash is king nowadays. I mean, obviously. There is a question specifically about the staff line investment. Perhaps could provide a little bit of color as to the rationale for that.
Yeah, actually, I think when the London market, today we will be announcing that we basically have increased our holdings in Staffline just a little bit to 15%. Why? Sorry, what was
The rationale in investing in Staffline.
Okay, so when we first went into Staffline, it really was the idea was to have a tripod. As in, we wanted a leg in Europe. We had been considering possibly Benelux or the UK. And after studying it, we felt that, it basically, the UK just made quite a lot of sense. Whether legally or linguistically, it's just a lot easier for us to look into it. And when we first studied Staffline, it actually made a lot of sense for us. Thereafter, a whole series of events happened, right? So, if you followed the Staffline saga, it was really quite dramatic. You had Brexit, you had them losing their auto clients when BM and all kind of ceased operations there for a while. And from 55,000 contractors out daily, at one point it was down to 30. Yeah, so that was pretty horrifying. But we kind of kept in very close touch with the company, and in fact, we were very involved when they put in place new CEO and new CFO. People who we had known previously. For Albert Ellis, who's the CEO, we had known him from our previous investment in the UK, Harvey Nash, which did very well for us. And then later on, when they were looking for a CFO as well, we thought that Daniel made a good CFO because he came from Robert Walters and he came from within the industry. And we felt that that would give him a much stronger sense of managing the company. So we've been working with them for quite some time now, actually, since pre-COVID. And we do see the company kind of turning a corner. I mean, in fact, if you look, what the analysts have written out and published as well, is that they do expect the company to turn quite nicely positive by 2023. And so we do want to take full advantage of that by the time that comes after kind of working with them for so long. Yeah, so Staffline, it really was a very challenging investment for us, but it does look like it's finally turning the corner. Yeah, so they're back up to, I think, about 45,000 contractors and much more decent numbers. Yeah.
I guess a rising tide will lift all boats, right? So it's been a couple of months, years since Brexit, so on and so forth. So it's coming back, right? And there's a fair bit of revenge shopping and people going back to the office. Yeah.
I hope
All
so.
right. There are two more, I would say, kind of like logistical questions. So it's about quarterly reporting. So we consider doing quarterly reporting, as well as a participant has asked about getting a hard copy annual report.
Oh, sure. I mean, if you'd like us to print a copy for you, that's not a problem at all. We're happy to do it for you. But basically, the reason why we swapped out was because of our sustainability commitments. So currently, we don't even print name cards anymore. We use QR name cards. Can you imagine for recruiters?
Is that a thing? QR name cards?
Yeah.
I think I should get one.
Totally. Yeah, so basically, we have tried to cut our printing as much as possible, because when we were kind of looking at our sustainability targets and all, that was one of the things which we found easier to do. I am not sure whether this whether you see this. Yeah, so anyway, for example, this was for a client event, so this is an example of a QR name card. If you scan it, then you'll get our contact details. Yeah, so we've been using QR name cards. Yeah, so that's why. But if you would prefer a hard copy, please just drop us an email and we're happy to print out one for you. That's no problem.
Okay, great. So I learn more and more every time I get on this kind of QR. Yeah, I feel like a dinosaur. Maybe one. Sorry.
No. I mean, if you think about, actually, we got the idea from WeChat, right? When we were in Shanghai a lot. And nobody was exchanging name cards anymore. Everybody's just adding each other on WeChat using the QR code. Yeah. So,
Yeah, I mean, you can go out in China without your paper money. You just handphone and everything works. Yeah,
yeah.
we are a bit behind. Not, I am very far behind. Okay, maybe one last question since we are ran out of time. So no presentation at SIAS is complete without this last question. It's about risk factors, obviously. All right, so we've talked about your projected growth plans, all of the above, M&A, share buybacks. We've talked about the profit trajectory. What about risk factors? So in terms of, it could be anything, competitors, regulations, zombie apocalypse, whatever.
I think currently the answer must be, COVID, right? It still is. It does look, even though we're at peak numbers now, it does look as though hopefully it's not affecting us as much. I mean, as Geoff mentioned, I mean, that's what we put out in an annual report as well. It looks as though psychologically employers have kind of settled in. And even in Shanghai, the fascinating thing was that even during lockdown, our clients were still hiring, right? So it kind of shows that hopefully, nowadays, even if we have to go to any other heightened alert and so forth, we're familiar working from home and onboarding from wherever you are. So yeah, if all goes well, we should be okay. But otherwise, every time there was a lockdown, it definitely had an impact on us. That's a fact, especially with the permanent recruitment side of things, because it's quite natural that people then say, "Oh, let's just halt hiring for a while."
Mm.
Yeah.
Okay. But what about I don't know, the recession, or maybe not.
Yeah, I mean, if it happens, I would say, we are not recession proof. That's a fact.
Mm.
We just have to go on out to, you know, fight our way to profitability and growth. And it's sometimes it sounds as if, why are we talking about fighting, but that's the case, right? So there's this conscious idea that we have to be very aware of where we can contribute, and our thought is that so long we can add value to a situation, the profits will come,
Mm.
right? So right now, for example, with this idea that I think we're quite short of nurses, so that's an area that we do intend to, enhance focus on, put more people there, deploy more of our consultants to focus on that area. Yeah, that's something which is quite typical of us, lah. Yeah.
Okay. And I mean, certainly it's quite reassuring looking at your historical track record since the late 1990s, right? And the company has obviously executed well, and because of the compensation structure, the co-ownership, as well as the way consultants are paid, that's quite different from all the companies out there. So certainly it has borne fruit over the last 2 decades.
I mean, to give everyone comfort, right? 80% of the company is owned by people who work there, right? So it's very unlikely that we'll want to screw it up. I
All
would say
right, so that
we're
is the bottom line.
deeply invested, deeply invested, and it's not. I mean, I don't want to sound flippant, because sometimes when I say that, oh, all these co-owners invested a few $100,000 each,
Mm.
and then you get a response, oh, why is 300,000? I'm like, it is quite a lot of money. If you have a young family and you have heavy commitments and all, sometimes basically we have to work out plans with some of our co-owners to kind of make things possible for them. And we have, and this is where I would say you really sense, recently I was telling somebody, within our company, either we are family or we become family. So we actually have some bosses who basically loan money so that people who worked for them could then become co-owners, because they're like, don't miss this opportunity. If it's offered to you, take it, right? And if you're short of cash, this is it. Yeah.
Okay.
So they become family.
Well, certainly very reassuring for external retail investors. That everybody is all in it together. Quite different. Well, we have unfortunately ran out of time. We've run the gauntlet of most of the questions, the teams out there. So I would like to thank Adeline as well as Hrl Net Group. Thank you very much for joining us this evening. I had a ball of a time, and obviously very educational for me personally. Definitely need to go and get a QR code card. Yeah.
We'll make you one and send it to you.
And don't forget the free assessment on my CV. Yeah. So thank you very much, and we definitely hope to have you on, our SIAS events going forward, either in this format or some other format. So really look forward to working with you guys again.
Thanks for having us. Yeah.
Okay. Thank you very much, and over to you, Eileen or Michelle. Sorry.
Thanks, Adeline and Ben, for the insightful sharing today. We have come to the end of the webinar. We'd like to thank every one of you for joining us this evening. In case you missed any part of today's session, you can rewatch the webinar on SIAS YouTube. Corporate Connect is a bi-monthly webinar. Do visit our website to get updates on any upcoming investor education program and initiative. Okay, with this, we'd like to wish you a good evening. Thank you.
Thank you.